Hello there. Welcome to Section 3 of our free seminar. Let's talk about mutual funds and their costs. Believe it or not, there are costs to running and operating a mutual fund. Lots of expenses you have to be aware of. Annual operating costs, trading costs, 12B1 marketing charges. Don't forget sales and commission charges. You can't get away from these. Let's go through each of these in turn. You must pay the portfolio manager, analysts, traders, operations, marketing, compliance. These are annual operating expenses that you must pay and can be up to 3% per year forever. And then there are called the loads. These can be paid either upfront or when you sell. These are commissions or sales charges for buying or selling the fund. Depending on which class of fund you choose, you either pay the sales charge up front or at the end, called the back-end load. These total costs can add up to 8%. What do we mean by net asset value? The net asset value is the price of a share of the fund. So if it is $100, imagine putting in $100 and you get charged the load at the front end of 5%. This is the initial sales commission, and so you are investing $95 instead of $100. These loads typically range from 4 to 6%, okay? And this goes to the broker or advisor who sells the fund to you. So let's take an example and make this even more real. After your 5% commission or sales charge, starting with $100, your $100 is invested at $95. If you take into account the operating costs, that it's another 1%. So now you're investing $94. And if you are actually paying an advisor another 1% per year to help manage your money or pick these funds, that's another 1%. Your $100 just became $93. Good luck with that. You're automatically down 5 to 7%, and you have to play catch up with the markets already. Can you see how this can all add up no matter which class of funds you buy? Again, this can range from between 0 to up to 8%, combining the front-end charges or back-end. The 12B1 fees are including in the operating expense ratios. Avoid the load. So when you look at the returns on Morningstar, be sure to understand you need to take into account the costs. That is not the actual returns you get when you look at the performance. Take away the fee, such as the load, the operating expenses, and even the financial advisor fees from your original investments. Okay? The net asset value that you sell at minus what you originally bought it at, NAV 0, plus some capital gains, divided by NAV 0, that's the return that they show you. But you need to figure the performance after all the fees. Now follow along here, because here is where it gets really interesting. All of this adds up over time. If you start year 0 with $100,000, at the end of 10 years with a 7% compound return, you pretty much have doubled your money to $197,000. But if your $100,000 starts out at $95,000, remember, minus the sales commission charge of 5% load, but then you subtract another 1% per year for operating expenses, you have $27,000 less at the end of 10 years. If you are paying an advisor an additional 1%, you end up with just $155,000. That is nearly $43,000 less than what you would have had with no fees. And check this out. The gross performance of load funds is statistically identical to the gross performance of no load funds. You heard that right. Load funds performance is the same as those with no loads. where there are no commission charges up front or at the back end. So funds with high expenses actually tend to be poorer performers. The bottom line, always choose a no-load fund. They perform just as well. Now let's not forget about turnover. With a mutual fund, that fund pays commission costs on whenever they buy and sell stock. That's charged against the NAV. So the higher the turnover, the more they buy and sell, that impacts the NAV negatively. So just be careful of watching the fund turnover. Whenever there is high fund turnover, just be careful. So the summary, 60 to 80% of funds underperform. If you remember our supermarket picture, remember how difficult it is to actively pick stocks to beat the market, to actively pick the best fruits and veggies? Well, big institutions pay millions of dollars to analysts, which might succumb to bad investing or bad behaviors or bad analysis and end up underperforming the market. That doesn't even take into account the fees. I know, because I've worked with literally hundreds of analysts in my lifetime, and it's hard to pick outperforming stocks, even with all the academics and experience. I witnessed firsthand all of this. So 60 to 90% of funds might actually underperform after fees. Let me tell you 2 additional points. The overall performance of funds do not include funds that have failed. That's right. When you look at the average performance of mutual funds that experts talk about, it does not take into account those mutual funds that have blown up or failed. They simply are left out. So the performance of the average fund could be even worse than you think. But wait, you say you found a fund that has done really well. Well, guess what? The best performing funds are usually the worst in the upcoming years. You heard us right. Studies have shown that the top quartile managers in 3 to 5 year periods, in other words, the best managers in a 5-year time frame historically, if you go forward, 75% are no longer there in the upcoming periods. That is, they did worse than expected. The same goes for bonds. So was it just dumb luck or skill that they did well in the past few years? Well, that, my friends, you have to decide for yourself. But at least now you know that even with the better performing funds, you're taking your chances. Better lucky than good, I guess. Now you understand all about mutual funds. Unless you have the time, expertise, and understand ratios to pick the best mutual funds, which MoneyPangs can certainly help with, what's the alternative to managed active mutual funds? What's the alternative? That's our next section.